got a national agenda to go.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, and thank you all for joining us for our Knowledge Matters webinar today. My name is Kevin London. I'm with the Apple Specialist, and today we have Meg Lawson from Crabtree, Rowe Berger. Meg is an accountant, and she works with Crabtree, who presented for us last week, and it comes highly recommended. And today's presentation is basically accounting 101. It's the basics of accounting for non-financial people like myself. And I'd like to thank you for joining us, and I'll turn it over to Meg.
Thanks, Kevin. And thanks again to Greg for setting this up. This is a presentation that I developed the curriculum myself and just have a lot invested in it, and I really enjoy teaching accounting, so I'm thankful for Crabtree to allow me to kind of explore that and do these webinars. So we'll just dive right in. So all right, so our agenda today, we'll first start with some basic accounting concepts, some terms that you need to know that we might kind of throw around if you hear your accountants or CPAs saying words and you're going, what are they talking about? We'll go over some of those. We'll talk about accounting transactions. And the reason we do this is that a lot of accounting systems like QuickBooks or Peachtree or other accounting systems you might use, they kind of mask what's really going on in the background, you know, how a transaction is recorded and what actually happens, let's say, when you enter an invoice or receive a payment or enter a bill. So we'll go through what's actually happening and the accounting sort of theory behind that. We'll talk about a monthly close process that Crabtree recommends to our clients just to get things closed out right and started for the next month. And then we'll have a time for questions at the end, and I will welcome any questions that you may have. All right, so first of all, why is accounting so important? It helps you price your product accurately, know if you're making or losing money in general for your whole company or on specific products or jobs, so you can look at product lines or specific clients and see whether you're doing as well as you could be. Know what your cash flow is. Work with your bankers and investors if you have debt or contributed capital. Helps you project your future activity reasonably. And our favorite, helps you report to tax agencies and maintain compliance with all regulations that you may be privy to. Okay, some accounting terms to know. A fiscal year, when we say fiscal year, that's just the definition of when a company's year begins and ends. Usually it's the same as calendar year, but it doesn't have to be. It can be, some companies choose to make it different because of their business cycle, if they're seasonal. Okay. When we use the word current, what we mean is that the life of whatever asset or liability that we're talking about is less than 1 year. And when we say long term, that's obviously greater than 1 year. And when we use the term liquidity, we mean when the conversion to cash is expected. So what I mean by that is when you're talking about accounts receivable in your business, that is a current asset because you expect to collect that money from your customers within 1 year, hopefully. Now, you always have some stragglers that you may have to call after. But in general, accounts receivable are a current asset because the life is less than 1 year. A building or a vehicle is an example of something that's long-term, and the conversion to cash, so selling it or disposing of it later, is expected to happen in greater than 1 year. You're going to use a building or a vehicle most likely for longer than 1 year. And, this may seem silly, but we use the word reconcile a lot, and usually you hear that when you're talking about a bank account. You're reconciling what is my balance in my checkbook to what the bank says I have. Well, we can reconcile all different kinds of balances. And so I just wanted to point out that all of reconciliation is let's take the same account, and it's got two different balances in two different places, and identify the specific differences that make up the difference in the balance, and reconcile those. All right, when we say a prepaid expense, that represents cash that has been paid out for an expense that will be incurred in the future. So a common example of this is an insurance policy. If you've got property insurance or liability insurance in your business, usually you're paying that premium once a year or once a quarter, and so you have to pay that, kind of a bulk sum up front, but really you're using that policy throughout the year or throughout the quarter. And so what we do with that insurance is we make it a prepaid expense, and instead of taking the full expense of that whole policy in whichever month you pay for it, you're going to spread it out over the life of that policy. An accrued expense is the opposite. This is an expense that's been incurred, but you haven't paid out the cash for it yet. So the most common example of this is payroll. Most employees are paid twice a month or every other week. And a lot of times, it doesn't fall right on the end of the month. So you're going to have an accrual at the end of the month for those wages that your employees have earned but haven't been paid yet, because payroll doesn't hit until the 5th or 6th of the next month. But you want to go ahead and get that expense on your books because your employees have earned that portion of their paycheck, those 5 days or however many days it is. When we say fixed assets, we're just talking about vehicles, buildings, equipment, large equipment that you're going to expense over a period of time using depreciation instead of expensing it all at once. So let's say you buy a box of paper, a box of 20 reams of paper. Usually you just go ahead and expense that because you're probably going to use that in the next month or so. But a vehicle that you purchase, you're going to use that over 5, 6, 7 years. So we call those fixed assets. So we depreciate those over time, over the time that you use them, instead of all at once in the period that you paid for it. And when we say capitalize, that just means we have decided that this purchase, we're going to call it a fixed asset. So we're going to capitalize it instead of expensing it in the month that we purchased it. And depreciation is just the term given to that expense of fixed assets over time. And when we get into the accounting transactions, we'll go over that in a little bit more detail, how all of that works. Okay, just a few more terms. When we say gross and net, a balance that we're reporting net of something has been reduced by another balance. The most common example of this is accounts receivable. if you have an allowance for bad debts, which is sort of a cookie jar that you set aside for clients or customers that you don't think you're going to collect fully from, if you have 10% maybe of your accounts receivable aren't collectible, then you set aside an allowance for that. Well, you can either report that accounts receivable balance gross or net. Gross means we're going to report just the accounts receivable balance as it stands. If we say accounts receivable net of the allowance, we're reporting it net less that allowance. So let's say the allowance is $100,000. You're going to reduce your accounts receivable balance by that much to show that here's what we think is really collectible. A contra account is the name that we give to accounts like allowance for bad debts or accumulated depreciation. It just means that it's an account that's used to reduce the value of another account. When we say book value, that just means the value of your asset or liability according to your accounting system. And we most often use that to describe fixed assets. We're going to say, what's the book value of this piece of equipment? P&L just means profit and loss, another name for the income statement. And a capitalization policy, which is something that we recommend all businesses implement, is the minimum cost at which a purchase might be considered for capitalization or to become a fixed asset. So let's say you've set your capitalization policy at $1,000. Anything under $1,000, you're just going to expense it because it's not worth fooling with all the depreciation. You're going to have, $12 or $20 a month of depreciation. It's just, just doesn't make sense. It's a lot more effort than is really necessary. But anything over that, you can look at and consider how you're going to use it, how long you're going to use it, and whether you think you might need to capitalize that so you can spread your expense over a period of time. All right, real quickly, I just want to go over a chart of accounts, which is just the list of accounts that's used in your business. And we usually see that organized into groups by type. So the five major types are assets, liabilities, your equity, then income and expenses. And each account should have a unique number to avoid confusion. And I know some accounting systems don't make you give account numbers to your accounts, which I think is kind of silly. But I think it just makes life a lot easier when you can point to a specific account number and say, you need to report it to account number XYZ or 123. And so here's sort of a blown out look at the chart of accounts. And what I want you to notice is that on the assets and liabilities side, it's organized by liquidity. So, go back to what we said liquidity was. That's a measure of when is the conversion to cash expected. So obviously cash is at the top because it's already cash. You can't convert it any more to cash than it already is. And then you go in order by how soon you expect these other items to be turned into cash. So you've got accounts receivable, your prepaid expenses, then your fixed assets, and then any other assets that you might have, shareholder receivables, security deposits, those kind of things. And the same with the liabilities. It's organized by liquidity as well. Then under equity, you've got your common stock, retained earnings, distributions, and then you might also have an account for any owner contributions to the company. Under income and expenses, usually start with your revenue, start with the good first, your income, and then you've got your cost of goods sold next, and then all your operating expenses. And we usually like to break those up into major groups. so that you can do sort of a collapsed P&L and just look at the major line items, and then drill down into what accounts make up those major groups. And then other income and expenses, which is, interest income or just other kind of miscellaneous things that can't really be classified into one of the other groups. Okay, so here's the meat of accounting, is accrual basis accounting. So first I want to point out cash basis accounting reflects only the inflows and outflows of cash. You don't have accounts receivable, accounts payable, prepaids, accrued expenses, any of that, because you're only accounting for cash when it comes in and cash when it goes out. Accrual accounting is based on what we call the matching principle. So what that means is you want to match the revenues that your business is earning with the expenses that were necessary to generate those revenues in any given period. That's the best way to give you a picture of the sort of engine of your business and how well it's churning. So expenses are recorded when incurred, revenues are recorded when earned, regardless of when the cash is actually exchanged. Okay, so that's what creates that accounts receivable, accounts payable, prepaids, and accruals. And on the other accounts that you might have in an accrual basis business that you wouldn't have in a cash basis business. And we'll get into more detail in sort of a line item by line item style when we get into the accounting transactions. Okay? The accounting equation is the engine that drives this field. Okay? Everything is sort of based off of this equation. And the equation is that assets of the business always equal the liabilities of the business plus the equity of the business. Okay? So go back to 4th grade science or whenever that was that you learned the saying, for every action there is an equal and opposite reaction. Okay? That applies to accounting. Anytime a transaction is recorded in your accounting system, it affects at least 2 different accounts. You always have at least 2 lines, usually more. But that accounting equation always balances. If it doesn't, you get an error in your accounting system that comes up and says, this equation or this transaction doesn't balance. You have to fix something. You put things, both things on the debit side or both things on the credit side, or the numbers don't quite add up if you've got more than 2 lines. So that equation always has to balance. So if you remember that as you're thinking through how would I record this certain thing that happened in my business, I think that will help you tremendously. And I also want to point out that the equity in that equation, this is sort of a condensed version of the equation, okay? Equity includes net income of the business, both the past net income that you've had for previous fiscal years and your current net income for the current period, okay? All right, so let's do some examples of accounting transactions so we can kind of put the equation to work here. And I've blown out the equation one step further. So instead of just assets equals liabilities plus equity, I've added the plus revenue minus expense, okay? All right, so I'm going to use this handy-dandy Excel worksheet that I've developed here so we can illustrate these transactions I'm going through. Okay, so under accounts receivable, one thing that you'll do is record an invoice. You're billing a customer for work you've done. Okay, So in QuickBooks or another accounting system, it's real easy. You just go right up to, customers and create an invoice. Here's what's happening to your accounts behind the scenes, what QuickBooks is doing for you, okay? You're going to, so let's say the bill is for $1,000 worth of work, all right? What it does is it goes under accounts receivable and adds $1,000, okay? And it also goes under your revenue account and adds $1,000. So you've earned that revenue, you've billed the customer, so it creates that receivable, so you know that they owe you that $1,000. And you'll notice that the equation balances, right? We've got $1,000 on one side and $1,000 on the other side. All right, so let's say it's 30 days later if you're lucky, or 60 days or 90 days, and you've had to call the customer a couple of times, and they've paid you for this invoice. So what QuickBooks does when you go in and receive a payment is it reduces your accounts receivable by $1,000, and it adds $1,000 to your cash, right? So basically that's just a transfer from one asset to another, right? You've converted it into cash, so that's what that cash conversion thing is we're talking about. And the equation still balances. And what I want to point out to you is the most important thing about accrual basis accounting is that you don't want to record a revenue or an expense twice. Okay, so what you don't want to happen is you record the invoice, let's say just like I recorded it a minute ago, and if you receive the payment from a customer, we don't want to go in and add $1,000 to cash and add another $1,000 to revenue. Then we've overstated our revenue, we've doubled up. And we've still got that $1,000 in accounts receivable, so it looks like the customer still owes us money, but we know they don't. So that's another thing I want you to keep in mind when you're working with your books is, was this recorded, was this doubled up on? Is this a true reflection of what actually happened? All right, so let's move on to prepaid expenses, okay? So one thing that we like to suggest is that you use some kind of offline method, and Excel spreadsheets work well. If you have another way you want to do it, that's fine, to track these prepaid expenses, because you're going to want to be able to have a list of each one, when it was paid, how much the premium was, and what period that premium covers, so that you know what your expense should be every month. Okay? So let's illustrate that. So let's say that you've got a bill for your insurance policy, and you're going to pay that, and it's $1,200 per quarter. Okay? So what you're going to do when you pay that is you're going to, it's going to add $1,200 to your prepaid expenses and reduce your cash by $1,200. Okay? So this is another one, another entry that's sort of a transfer of assets. You've moved it from cash to a prepaid expense. And notice again that our equation still balances because these net out to zero, right? So let's say for simplicity's sake that I paid that insurance policy on the very last day of January. So I used the policy for the whole month of February. So what I need to do is take some expense on that policy for that month. Okay? So since it's paid quarterly, I know that I'm going to use it for 3 months. So I need to use up a third of that prepaid for this month, okay? So when you make an adjusting entry at the end of the month to expense this prepaid, you're going to subtract $400 from your prepaid, and you're going to go over to your insurance expense account, and you're going to subtract $400 from your income because you're expensing that insurance. So I want you to understand that this is the illustration of that matching principle, right? You want to match your expenses to the period that you actually used it up, right? Okay, so let's go through fixed assets. And again, we recommend that you track your fixed assets offline. And when we say offline, I just mean not within your accounting system. Now, if your accounting system has a function that will let you do that, that's great. Not all of them do. So if you want to use that, that's fine. But you want to track them by the date you purchased it, the amount that it cost, and what useful life you're going to use for that asset. And useful life is just how long am I going to use this asset for? 5 years, 10 years, 15, 30. Okay? So let's illustrate the purchase of a fixed asset. All right? So let's say you go out and you buy a $20,000 car. Okay? So you're going to write the dealership a check for $20,000, which will reduce your cash. And you're going to take that car and capitalize it, which means you add it to your fixed assets. Okay? So pretty simple. Where it gets confusing sometimes is how do we record depreciation expense, and what happens when we sell the asset. Okay, so let's start with depreciation expense. Let's say, again, for simplicity's sake, that you only record depreciation once a year, which a lot of companies do. And again, that's a decision that's up to you whether you want to do depreciation monthly or just on an annual basis. Okay, but just for simplicity's sake, we're going to do it annual basis. Okay, and let's say that you selected a useful life of 5 years for that vehicle. And there are some guidelines for selecting a useful life. You can't just kind of pick a number out of thin air. All right, so let's say you've used that asset for a whole year and it's time to record depreciation on it. Okay, so if I'm going to use the asset for 5 years and it costs $20,000, then it follows that my depreciation each year is going to be $4,000. So what I do is I go into my accumulated depreciation account, which is a contra account, remember, so it's kind of included with your fixed assets group. Okay, so I haven't shown it separately here, but just know that it's a separate account. Okay, so whoops. Okay, so we're going to take $4,000 away from the book value of that asset. That makes sense logically if you think through it, right? You've used it for a whole year. The value of it has depreciated, right? And then you're going to go over to your depreciation expense account and take $4,000 away from your income to represent that depreciation expense of using that asset. Okay? So I want to reiterate that all we're doing here is we're taking that money that you spent on that asset, right? And instead of taking a whole $20,000 of expense in whatever month you bought that asset, we're spreading that expense out over the time that you're going to use it. Okay? So let's say shortly after you record this depreciation expense, you decide that you're going to sell that vehicle. You don't need it anymore, or for whatever reason. Okay? So there's a couple different things that can happen. You can sell it at either a gain or a loss, or neither. If you sell it for exactly what it's worth, you don't have a gain or a loss, right? So let's assume that you sell this car for $15,000. Okay? So the first thing you want to do is let's compare our sale price to the book value of that asset. What's the book value of the asset? It's $16,000. Book value is the cost that we paid for it minus whatever depreciation's been taken on it up to this point. Okay? So if you sell the car for $15,000 and it's worth $16,000, you've got a loss of $1,000, right? So you would record that by, first, you're going to get that check from the person who's buying it from you. Okay? You're going to get rid of the value of that asset. Okay? And you are going to go down to your gain or loss on disposal of assets. Okay? And you are going to take a $1,000 loss on that asset. And notice that our happy equation still balances, right? And if you sell it at a gain, it's the same entry, just, you know, your numbers are going to be a little bit different. You're going to end up with a gain instead of a loss, right? Okay, and I just quickly want to run through some examples of other assets. I mentioned receivables from shareholders or affiliate companies. Usually, these are what's going to be known as balance sheet only transactions, which means they're not going to affect your revenue or expense at all. The only difference would be if there's an interest provision written into that that note that the owner has signed. If they have to pay you interest, then you're going to have interest income on that. But if it's balance sheet only, all you're doing is, so let's say the owner borrows money from a company, you write the owner a check, and you create a receivable on the books for the amount that the owner owes you. And then when the owner pays it back, you deposit that check, so you increase your cash, and you reduce that receivable by how much they paid you. Okay, so that's balance sheet only, no revenue, no expense. Okay. Security deposits on your buildings, utilities, those kind of things work exactly the same way. Balance sheet only. They should never hit your income statement unless you're not going to get the security deposit back. If you don't get it back, then you just recognize it as an expense. As soon as you know you're not going to get that deposit back, go ahead and recognize it as an expense. Okay? Some other assets, employee advances, again, is a balance sheet only, works similarly to the owner receivable. And I'll just quickly mention, when we say intangible assets, those are patents, trademarks, goodwill that you might have in the business. And these work similar to fixed assets, except the expense is called amortization instead of depreciation. Don't ask me why. I couldn't tell you. All right. Accounts payable. So, as you might expect, this is similar. The way this works is similar to accounts receivable, except instead of, so let's say you're recording a bill from a vendor. Okay. You made some purchase and they've sent you an invoice. So let's say the invoice is for $1,000. You're going to go under it goes under your liabilities. You increase your liabilities by $1,000 by putting that bill in accounts payable. And then whatever expense account that affects reduces your net income by $1,000. And our equation still balances, right? Because this is all on the right side of the equation. Okay? And subsequent payment of that bill, of course, decreases your cash and decreases your accounts payable. Okay? So again, I want to point out the expense only gets recorded once. You spent $1,000, so that's all that needs to go in the expense. You don't need to record it twice. Okay? So you can kind of see that the accrual accounts are almost sort of a holding pattern. And that's because in accrual basis accounting, you are, it's the matching principle. You're matching those revenues and expenses with the period that they should go in, regardless of when that cash was spent. Okay? And then if you have credit cards in the business, those are treated similarly. You get the bill from your credit card provider, and you enter all those charges. You know, they go to the various expense accounts that you're putting them to, and then you have a bill in your accounts payable for those credit cards. And then when you pay it, you reduce your credit card payable and reduce your cash. Okay? And I do want to mention about credit cards. And these are one of those things that always gets billed after the fact, right? And you know, kind of like utilities. You don't know how much your utility bill is going to be until you get it, you know, 10 to 15 days after the end of the month. And so, and one of the important things about accrual basis accounting is when you get that credit card statement, and they usually run on a schedule that's off from the beginning and end of the month. They usually end on whatever day that they think is going to give them the most interest, right? So if that bill cuts off on the 16th of the month, then you know you've got charges that were incurred in 2 different months, right? So you want to make sure that those charges get recorded in the month in which they were actually charged. So I know that seems like a lot of work, but in order to truly achieve this matching principle of what did I have to spend in order to generate the revenue that my company generated this month, you really want to make sure that those charges get put in the correct month. Okay? So accrued expenses, that's the opposite of prepaid expenses. So again, as you might expect, the transactions are similar. So recording an accrued expense increases your accrued expense account, and you increase one of your expense accounts. So whatever the accrual is for, whether you're accruing income taxes, payroll, or sales taxes, you're going to, you know, hit that expense account and increase your accrued expenses. And then later, when you pay it, you want to decrease your cash and decrease your accrued expenses. And what we run into a lot in our business working with our clients is people do a really good job of accruing expenses at the end of the month, and then they forget to reverse them out the next month. And so expenses get recorded twice. So an example of that is accrued payroll. They accrue the payroll, and then when they actually run the payroll the next month, they hit all the expense accounts again. Okay, so they've doubled up on the accrual that they had. So you want to make sure that if you're using accruals, that you reverse them properly. So what should be happening if you're accruing payroll is when you actually run payroll the next month, some of it should go to expense, whatever was actually earned in that month that you're paying it, and then the rest should go to reverse out what you accrued last month, okay? And when I say reverse out, I just mean you're reversing the accrual account. So it doesn't look like you owe any more money, right? You're not recording the expense twice. That's the most important thing. When you have debt or notes payable, one thing to remember is that it should be split between current and long term. And remember, when we said current, that's conversion to cash is expected within 1 year, and long term is over 1 year. So if you have a note that's longer than 1 year, which they usually are, you want to make sure that you've got a current and a long-term account on your books and you're tracking those. This is just a good exercise, especially for cash flow forecasting, so that you know, okay, within the next year, how much do I know has to be set aside for debt service? So if you have a bit of debt that is interest-free in a land called every business owner's fantasy, okay, then this is again going to be one of those balance sheet only transactions. But usually you've got interest associated with debt, right? So let's talk through what happens when you get some new debt. So if you borrow $100,000 from the bank, then they write you a check for $100,000. So that's going to go in your cash account, increase your cash. But you also now owe that back to the bank, so you're going to increase your note payable account, okay? Now let's say that it's time for your first monthly payment. The thing I want you to remember is monthly payments, if you've got a loan with interest on it, should be split between principal and interest, okay? So when you make that payment, so let's say, let's go back to my illustration here. Let's say you're making your first $500 payment on this note, okay? And they've given you an amortization schedule, hopefully, that tells you how much of each payment is principal and how much is interest. So per your amortization schedule, you know that this first payment, $300 of that is interest and $200 is principal, okay? So what's important about this is that that $300 gets recorded in expense, okay? And then the $200 gets recorded to your notes payable. And then the now wait a second. Oh, I'm sorry. Put that in the wrong column. Sorry. The notes payable is a liability, so that goes under your liabilities. See, this is again the great thing about that equation. I could look at that transaction the way I recorded it at first and know that that wasn't right because it didn't balance. Okay, so that helped me realize, oh, I put it in the wrong column, so it needs to go under liabilities. Okay, so back to what's important about that is that if you recorded that whole $500 to the notes payable account, it would look like you owed less on that note than you really do. Okay, because that interest that they're charging you should go to expense, and only the portion that's actually reducing your principal based on your amortization schedule should go against that note, okay? And then if you finance the purchase of a fixed asset, like a vehicle, we keep coming back to that, but it's the easy thing. This doesn't affect cash usually, unless you have a down payment, okay? But let's say you don't have a down payment, you're financing the entire purchase of that vehicle. No cash has exchanged hands, right? So you're going to increase fixed assets by whatever the price of that car was, and then instead of decreasing cash, you're increasing your debt. Okay, you now have a note payable for that vehicle, so you have to show that you owe that to the financing company. All right, and some other liabilities. This is payables to owners or affiliates instead of receivables. Again, it's balance sheet only. You're just talking about your cash account and a payable account, unless, again, there's interest involved. Okay? Customer deposits. And I don't know how often this happens in your businesses, but occasionally you might have a customer pay in advance for services or products. Sometimes this happens just depending on your invoicing schedule, and this happens a lot in service-based businesses. But the important thing to remember about customer deposits is if they're paying you in advance, then by definition that means that you haven't actually earned that revenue yet. So the important thing to remember is that you shouldn't just throw that customer deposit in revenue. Okay, so what it does is it sits in this liability account called customer deposits until you actually earn it. And then you can recognize the revenue on it. Okay? So let's talk about equity. Distributions to owners, whether it's for, if the business is helping the owner pay for his portion of tax related to that business, if it's a sole proprietorship or an S corp or whatever it may be, distributions are not an expense. Okay, they're kind of what's called a below the line transaction. It's considered after net income. Okay, so it's a distribution of profits, basically, right? So a distribution should not be in an expense account. It goes to decrease the owner's equity in the business, okay? And vice versa, any contributions from the owner are not income. If it's a pure contribution, not the business is going to pay it back or anything like that. If it's a pure contribution, it increases the company's cash and it increases the owner's equity in the business. Okay. One other thing about equity is that the net income of the business for that period is closed out to the equity account called retained earnings at the end of each fiscal year. Okay, and your accounting system does all of this for you. So what that means is that all your income and expense accounts, once you've done all your year-end adjustments and you're happy with all those numbers, they're zeroed out and put into your retained earnings account so that for the next fiscal year, you start with zero net income. You start with a clean slate. Okay? So that retained earnings account represents the cumulative profits of the business since the business's inception, minus any profits that were distributed out to the owners. Okay? All right, so we'll talk about what we recommend for a monthly close process. And I have a handy-dandy checklist that I will email to the participants. And I'll also email the slides so that you can have those to refer back to if you need to. So the first thing that we recommend is look at a prior month comparison. So let's say you're getting ready to close out February. What we recommend is that you first print out a balance sheet and income statement, P&L, for January. Okay? So you take that and then you compare it to what you printed out at the end of January for the month of January. And I hope that makes sense. So you're comparing apples to apples. You're comparing January to January. But you want to make sure that during the month of February, nothing kind of funky happened to January's numbers that changed them. Because things can get really out of whack real easily if you start, changing prior months. But you want to make sure that you know the reason for any differences in that prior month. If it was something that you forgot to accrue, maybe, or something like that. Just make sure that you can identify all of those. Okay? For cash, obviously you want to do a bank rec every month and print a copy for your file. And if you want to do all this electronically, that's, of course, that's up to you. If you want to save it as a PDF instead of keeping actual paper copies, whatever works for your business. Follow up on any old checks that haven't cleared. Anything that's older than a couple of months, I would recommend looking into and, why hasn't this cleared? Did it get lost in the mail? Do I need to put a stock payment on it? Does this person need to be issued another check? Those kind of things. Because, I see it all the time. And we have companies, and I look at their bank rec and all these outstanding items, from months and months ago. And so what it does is it skews your cash balance. You open up your accounting system and it looks like you've got negative $5,000. Well, you may know that's not the case because you can look at your, your bank balance online. But you want to make sure that all the information that you need to make business decisions is in the same place, and that's your accounting system. So you want to make sure that that's correct and up to date. And then one other little ticky thing is just, when you void checks, just go ahead and mark them as cleared. I think this is a quirk in QuickBooks. I'm not sure if it happens in other accounting systems, but if you don't mark them as cleared, then they just show up month after month after month as uncleared. And even though it's a zero effect on the balance, it's just, you might end up with a list of 25 different voided checks, and it's just easier to just clear them off and get them gone. Okay? Accounts receivable, we just recommend that you print an aging report from your accounting system and just look at each person, each client, and the age of those receivables, and review for collectability or anything that's overdue, and follow up on those. And if somebody has a negative balance in their accounts receivable, follow up on that, because that could be a payment, misapplied or something similar. Okay? Prepaid expenses, you want to make sure your tracking sheet is up to date, your offline tracking sheet, and then make your monthly adjusting entry. And you can use that tracking sheet to tell you exactly what your adjusting entry needs to be. And then you've got that backup. If somebody comes to you and says, what is this adjusting entry that you made? You've got the sheet that shows you exactly how you came up with that number. Okay? Fixed assets, add any new purchases to that tracking sheet, remove any disposals, and then record your depreciation expense for the month. And again, that tracking sheet can tell you what your depreciation expense should be. And then if your accounting system does that for you, that's great. And it will calculate depreciation for you, and maybe even set up a memorized entry to go ahead and record depreciation expense each month. Accounts payable and credit cards. This is similar to accounts receivable. Just print out the aging report, look at it for anything that's overdue, look at it for any negative balances. Again, it could be a misapplied payment. Make sure you're entering your credit card charges in the right month, and complete a credit card reconciliation just like you would a bank reconciliation, and print for your file. I can't tell you how many businesses we have that don't reconcile their credit cards, and it's astounding to me, because I don't know how you make any business decisions without knowing, what's actually really going on. Accrued expenses, similar to prepaids. Make sure that any of your reversals, like we talked about earlier, have been done properly. And then any necessary adjustments to your accruals, if you need to record new ones or anything like that, go ahead and do that. Your debt, just look at, you know, you get your statement from the bank, look at that bank balance, what you owe, and make sure that if it doesn't match exactly with what you've got in QuickBooks, make sure it's at least close. If it's not, then you've probably misposted some of your payments. You know, that breakdown between principal and interest that we talked about. And then if you need to accrue any interest, like on a line of credit is usually where this happens, then go ahead and record that. Equity, if you've made any distributions during the month, make sure that those weren't recorded as an expense. Make sure they were recorded under the equity account. And income and expenses, we recommend that you look at a comparative income statement, and your accounting system should be able to do this for you for the last at least 3 to 6 months. And just look at sort of the trends, and you may want to have your accounting system do it as a graph. If you're a visual person, you need to see those. You can look for spikes or dips in certain accounts. And if you've got those, it doesn't necessarily mean anything is wrong, but you can drill down and look into it and see if something got misclassified in the wrong account, or something like that. If you do track revenue and expenses by job or customer or product, you want to print one of those classified P&L reports from your accounting system and make sure that everything got classified. So this is another problem that we see is you get a lot of expenses that were just not given a classification. So you have all of these expenses in unclassified, and then again, you're not getting a good picture of the performance on that job or product. Okay. Here's just an example of the monthly closing checklist that I'll send to you. I have it in an Excel version. We have a lot of clients who print it out and put it with all of their monthly reports that they print out, and they initial, each thing, so that if there's ever a problem, you've got that paper trail. Okay. Closing package. So this would just be, here's all the stuff that we recommend that you print out or save in a folder for each month. And so that includes your bank rec, your credit card rec, copies of the statements that go along with those, your AR aging, your AP aging, balance sheet, P&L by job, if that's applicable. And then if your manager or a controller or CFO wants to review other things, like a cash flow forecast, which we'll look at in a second, and any other items that they want to look at, it doesn't hurt to ask. If there's a report that they want to be able to look at and keep an eye on, then knowledge is power. I know that's corny, but that's truly what I believe. So this is a cash flow forecast that we developed here at Crabtree, and our partners actually get this on a weekly basis. Our admin is really good. She sends it to them at the same time every Friday afternoon, and they know exactly where their business stands for the next 3 to 4 weeks. So basically what it does is it says, as of this day, here's how much cash I have. Here's what my accounts receivable looks like. So you know kind of what to expect we're going to collect. And then this metric of percentage of AR under 30 days is just something that you want to kind of keep an eye on. If it starts creeping down on you, that means your accounts receivable is aging too much. And so that means you're slower in collecting, so you may want to look at ways that you can improve that. And then same thing on your accounts payable. And your percentage of AP under 30 days, you want to keep that as high as it can be. If it starts slowing down, then you're being slow on making your bill payments. And then just a list of what expenses, what payments are going to come up due in the next 3 or 4 weeks. So you can see at a glance am I good on cash? Am I not? Do I need to look at how I can leverage my payables to help my cash flow, just help you make business decisions. Okay? Does anybody have any questions? I know that was really fast. This seminar is usually 2 hours. I cut it down to 1 for the webinar just because I know we kind of tend to lose people. So, and of course, you'll have my contact information. If you have any questions ever, feel free to give me a call or shoot me an email if you don't have any questions right at this moment. No questions, Kevin?
Hi, Meg. I don't see any questions being typed in right now.
Okay.
We will, we'll post the recording and all the materials you just mentioned, the slides and that form.
Mm-hmm.
Get that emailed out to everybody early next week.
Okay, sounds great.
All right, well, I'd like to thank you very much for the presentation, and thank you all for joining us today, and watch your email box. We'll give you information on the resources from this webinar. Thank you again for joining us.
Thanks, everybody.